to Chicago Future of Finance. I'm Oliver Rennick. We are live on the SIBO floor, and we're going to talk some bonds. Sean Dranfield joins me, CEO of Performance Trust Asset Management, PTAM, Chicago-based here. About a $10 billion bond operation you're running. Sean, thanks so much for coming in.
Absolutely. Thanks for having me, Oliver. Great to be with you.
Thank you. Okay, so first thing right off the bat is you hear a lot about 60-40's dead, bonds are hopeless. How do you get to $10 billion if that's the case?
By having a better mousetrap. We look at bonds very differently. So, as everyone knows, rates have gone up pretty dramatically, right, in the last several years. We don't believe in rate predicting. So if you can build a rate agnostic portfolio that balances bonds that might help you if rates go up with bonds that might help you if rates go down, that delivers a smoother total return despite an upward movement in rates.
Okay.
So it's all about using better bond math. And so we have sort of this Moneyball approach to bonds that's, basically turns traditional metrics on their head, and it delivers this very consistent total return profile over time.
Is there any analog, and if not, please say no, but is there any analog to your process with, to some extent, how people are handling volatility in equities by basically kind of selling the lower probability stuff, trying to find income? Does any of that overlap? Does it compete at all?
So we don't do any probability math, but what we do is we say, where can you get math on your side? So if you think about playing blackjack, right, you're not going to hit on a 16, right?
Okay.
So
you've never been at the casino with me. It depends.
But what you're doing is you're looking for the best math you can find without being beholden to interest rate predicting.
Okay.
So we're not necessarily looking at probabilities, but we may buy good math that becomes attractive as a result of volatility.
Okay.
So an example of that could be, for example, if you were long munis so far this year, you'd look very foolish because we've had this big rates up move and a massive steepening in the yield curve, right? Well, on a go-forward basis now, the asymmetric math, the opportunistic math of that part of the yield curve is very, very attractive as a result of the volatility. So we don't use probabilities, but we look for the best math.
Okay. Now, how much of that is security? How many securities are in there? Like, is it a kaleidoscope of different types of bonds? Are you able to find these opportunities in deeply liquid, popularly traded markets, or do you need to go into the niche world?
No, so we'll go across all bond sectors. We tend to hunt at the top of the capital structure generally, but we're always trying to create this balanced portfolio of offense and defense. So bonds, again, that might help you if rates go up, combined with bonds that might help you if rates go down. So we're always going to have a fairly diversified mix of bonds, but we're sector agnostic. Like, it's all about where is the best math, right? Offensively or defensively. And that could be convexity, it could be spreads, it could be yield curve roll. It's where is the best math.
So you don't really care what happens in Jackson Hole, ideally?
No.
Okay.
No, not at all.
I imagine that's appealing to any advisors that want to have complements to their bond portfolio. Where does the fund, PTIAX, by the way, 5-star and Morningstar, second percentile since inception, you're beating the heck out of the ag 5, 7, 10 years. Who needs that product?
So the way our clients tend to use this is as a complement to more traditional bond managers. So if you think about somebody who's buying an index, right, or buying a traditional bond fund, they're in essence making a rate call. So if I think about the Barclays Ag, it's 45% treasuries, 25% IG corporates, 25% residential agency mortgage-backed securities. All of those bonds are rate-sensitive bonds. Rates go up, you lose. Rates go down, you win. Right? So that's what most traditional core plus bond funds look like. We don't look at anything like that. So our clients tend to use this as a complement to those funds. Those funds will do well if rates plummet aggressively in a short period of time.
Right, but we tend to trade.
Yeah, but we tend to deliver this more steady Eddie singles and doubles type approach to bonds.
That's the Moneyball.
Yes.
Performance Trust Asset Management, founded by partners of also Performance Trust.
Correct.
Separate entities.
Yep.
We're going to be talking with Performance Trust as well. So this is a great start to our show and a great start to our conversation, keeping me honest on bonds too.
Absolutely.
Sean, thanks a lot.
Thanks a lot,
Appreciate
Oliver.
you coming in.
Yeah, absolutely. Thanks a lot.
Great to continue the conversation. Sean Dranfield joining us from PTAM. PTIAX is the ticker.